presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for May the 13th, 2024. I'm Mo Ansari, President of Compak Asset Management and the Chief Investment Officer. Thank you for joining us today. Let's start first of all. Don't forget, I remind you every week, you can go to compak.com/media, sign up for this update, you'll automatically get it. You can also sign up for the weekly newsletter, the podcast, the weekly which is a much more detailed version of what I'm going to talk about now, and all the charts and everything else that fundamentally happen. That's Javed and I. We will do all of that, and you'll get that podcast also. All of it is free. All you have to do is go to compak.com/media. If you want the Market Minute, which is a one-page newsletter, you can just send us an email and sign up for that. It's all free, but go ahead and do that, and make sure you subscribe to this. Looking at the markets, we are up 1.89% for the week. The market just continues to rally. As you've heard me say for 30, 40 years, it's the earnings that drive the market. It's the mother's milk of the stock market. Just like money is what makes politics go around, it's earnings what makes the stock market go up. So good week for that. We saw the Russell slow down a little bit, up 1.21%. NASDAQ up 1.17% for the week. Best one, utilities. It's again, utilities go up when interest rates go down, and interest rates did come down last week and they continue to come down. Financials also doing well as interest rates come down, and then the rest of the market was sort of okay. Oil still coming down, backing down from that 89 area down to around 79 as the demand slows down and there's a slowdown in the economy that has put some pressure on it. So that's what we're seeing there. Interest rates about the same. 10-year was at 4.5. Started at the week before was 4.5, so we're still there. Not down, not up. I think the big mover, the big news is going to be the CPI, expected to come down from 3.6 to 3.4%. Same thing with the core, coming down from 3.8 to 3.6. If we do get those numbers, that would be the first sign we're starting to come back to the right direction, instead of for the last 3 months we've seen inflation tick up, whatever the reasons, the automobile insurance or the rents or whatever, it's all holding inflation up. We need the inflation start to point downwards again, and that'll give some more room for the Fed to be able to make interest rate reductions by September, starting those reductions by September. So we'll wait and see. One of the big things was earnings. Usually when earnings estimates come out, they usually continue to go down. That's what we've seen, and the average is they declined by about 4% from what the estimates are. You can see this year it's been peculiar. You can see that they're not coming down. They went down a little bit, came back up, down, and they're back up now, and they're expected to be very little difference in earnings than what was previously expected. That is a big deal, that earnings are coming out stronger than expected, and that's what we're seeing. A lot more detail on the weekly newsletter in the earnings report. This week we get the PPI, we get the CPI later on this week, which is, we get the core, and then we get the CPI, which is the big number. We get retail sales this week, and those are the ones that are going to really impact the market. If we do get an inflation number better than expected, that I think will definitely have an impact. Looking at the charts, we're continuing to move down in these markets. Looking at the S&P 500, we've seen it come down from, or sort of just continue to go up. Now we're pushing just about 1% closer to, this turned into a 3 instead of a 5, which was previously. So we've gone through wave 4, and now the target is 53.10 to 53.40. This morning we're trading at 52.20, so we're about 100 points off of it. No big deal. That's the initial target. I think we can get there, but then we come into the summer doldrums and we'll chop around for a while. I think it'll set up some more opportunities there. Weekly S&P chart, again, continues to move up. Same target, around 5,300 to 5,340. If we can get above that, then we get to about 5,500 or 54, and then 5,600 is the long-term target on the S&P. NASDAQ, same thing. As I mentioned, we got the ABC correction. That was after wave 5. Looks like we're starting a new wave count to the upside. If we can get above here, long-term target still on the weeklies is 17.1 to 17.7 is what I'm looking for on the long-term target. This morning we're trading somewhere around 16,000 plus or 200 plus or minus, very close to the all-time high that we're looking at. But the target still, this is wave 5. Now this could become 3 if we start moving up sharply and move towards this 17,100. So we're only about 1,000 points away from there. Looking at the 10-year note, interest rates, this 4.7, this gap right here provided some resistance when we got here. Now we come back below the 20-day. The 50-day seems to be holding at 4.41. We're at 4.48, sort of going sideways for the last week. If we get an inflation number lower than the 3.4, I think we can break this and come down towards the 200-day moving average. Crude oil continues to move down. There's a slowdown in the economies around the world, and that's putting downward pressure, and demand is falling off a little bit. That's putting some downward pressure on the oil market. Small cap had a nice rally. As I had mentioned, somewhere around here is a buying opportunity. Looks like we headed back to the 212 area, and I think we're going to exceed it. Next week I'm going to put out the projection from this high that we made previously to the next Fibonacci target. Gold pulling back a little bit, back and forth, down $31 today at $23.44. I think we're right about here. Breakdown below here, we come down to about $22.78, $22.80. We're trading, and we could trade in this range back and forth. We're in the fourth wave, which are usually choppy, as you've heard me say. Those are my thoughts. Again, don't forget to subscribe to all of this information. All of it is free. Just go to compak.com/media and you can sign up for that. Those are my views for May the 13th, 2024. Don't forget to tune in to the podcast, which will be available later on this week or later on tonight or early tomorrow morning. Until then, I'll be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.